Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Despite the financial bailout plan moving forward, no final agreement has yet been struck, at least at the time of this taping, and investors remain concerned. However, progress was made over the weekend as Congress reached a compromise plan. So, once again, we have reassembled our regular panel to review and bring you up to date, at least on their thoughts. And you know who they are, starting with Steve Reitmeister, our editor-at-large at Zacks.com, followed by Charles Rotblut. Charles, our senior market analyst. And, of course, the maestro himself, Kevin Matris, our maestro of stock screens and head of our Research Wizard division. So, Charles, I noticed that over the weekend, you made a point in a blog about this newly revised bailout plan that it's a positive. It's a move in the right direction. You list some of the highlights of it. Do you all agree with Charles that this is a positive move?
Well, I think first, I like Charles to kind of recap some of the stuff from his post because I think it kind of sets a good groundwork for the discussion today. So, Charles,
Okay.
why don't you give us a bit the breakdown?
Yeah, I'll kind of break it down. There's definitely a lot of improvements to this plan over the last plan. Specifically, when you talk about the $700 billion number, it's important to realize about half of it's going to be spent now. The other half is subject to congressional approval. Not all the firms will we're not going to buy back all the bad debt. Some of the bad debt will be insured versus actually being purchased by the government. CEO pay, particularly severance packages, are actually limited on this. As I said, we have increased congressional oversight on it. The government can modify mortgages, something Democrats want to help people going through it. And I think the other key provision is that the government has it set up to actually recoup the losses. We'll get warrants in some of the companies. And also, after 5 years, if some of the debt's not repaid, the government can actually impose a tax, or the president, whoever it is at that point, can try and find some other venue of getting the firms who participated to pay back the government. So, in theory, the taxpayers should not be off the hook at the end of the day for this massive bailout.
On the hook.
On the hook, excuse me.
Right, and therein lies the positiveness of this whole thing.
Right.
According to Charles.
Yeah, it is an improved package from before. Here again, some of the things that were obviously missing from the first go-around was oversight. And the second part about if we're going to extend up to $700 billion of money, where's the potential payback? As we see, there might be a potential payback with AIG and some of the other things the Fed has done. So it is an improved package, no doubt. Perfect. Right, history will be the judge of that, and as we find out, and I think what you did is made an excellent point of this in your article, is that history will be the judge of how well the Fed did. But in a time of crisis and where it's very hard to see things clearly, this is probably about as good as we're going to get at this time.
Kevin?
I do think that having some of these provisions where you're talking about oversight and also being able to pay back the government for the amount that's being invested to buy these distressed mortgages, buying these distressed debts. The thing that I worry about, though, is that they kind of split this bill up into two, and I wonder, how difficult it's going to be for the government to be able to go back to Congress and secure the additional $350 billion. In other words, is Congress going to be, having to see the market go up a certain percentage in order for them to consider this a success? How are they going to look at the original $350 billion to determine, yes, you guys are going to get another $350 billion to see this thing through? I just wonder if Congress is going to have the political will to be able to do what's necessary to really put this crisis to rest.
Yeah, there's been no mention yet of a yardstick.
Well, I think it's important to realize the $700 billion figure, that's not this line in the sand. When Bernanke and Paulson were questioned on it, they basically said, I believe it's 5% of outstanding mortgages is how they calculated the number. So they themselves don't know if $700 billion is adequate. It may be too much. It may not be enough.
Right.
And so it's important to realize that at some point in the future, we might have to raise the debt ceiling even further and get above that amount of money. At the same point, we might be able to actually get some of these assets in. Now that the government's created a market for them, we might actually end up spending less. So that $700 billion, that's by no means anywhere a precise number, and the actual number could significantly vary either up or down.
And that is a concern. I mean, if right now we're talking about 700 and they cut it in half and it turns out to be $1 trillion or more, will they be able to see this through? But I do think that that being able to put this plan through as opposed to doing nothing, I mean, doing nothing is not an alternative. So this is definitely a step in the right direction.
All right. Well, we try not to dwell on theory in situations like this, unfortunately, at the moment, until we get something concrete to go on. This is all we have to kick around is theory. But there are some out there who are now not bashful about making the point that, yes, while Wall Street may be in a serious condition, this, in fact, is not chaos. Would you guys agree with that?
Well, people are using some pretty big terms. So we use crisis now as if what's the big deal? It's just a crisis, okay? Or Armageddon, and I think, yes, some of the terms that are being thrown about in the industry and in the media are a little bit bigger than what's necessary. If we had another Great Depression in our hands, that would be pretty close to Armageddon. But I think that here again, Paulson and Bernanke are students of what happened back then, and that the Fed and the government did the exact wrong thing back then when they tightened credit. Okay, at the time of the Great Depression, because they were so worried about inflation that they tightened credit, which was the exact opposite of what's needed. So as you can see, they have the fire hose open in terms of getting money and liquidity and hopefully the credit markets moving. So I think it's better on that regard. However, you tell me how many friends you have that haven't talked about this. How many people out there haven't said to themselves, start to take a look at their balance sheet a little bit and start to think about maybe pulling back on their spending a little bit. So even if a bailout package comes and improves things, I think unfortunately a lot of damage is already being done in terms of what we're going to see for the economy. But here again, the term crisis, okay, and Armageddon might be a little bit too stiff.
Term.
But can we see a slip into a deeper recession? I think, unfortunately, I can't imagine us not doing that this time.
Right.
There are still opportunities in the market or ways of protecting yourself, and hopefully we talk about that today. But I just don't see how, at this juncture, the economy doesn't slip into, certainly something that's called a recession, and if not a lingering, longer slowdown than what we were currently thinking, previously thinking.
And to Steve's point, real quick, Zacks Equity Research, we just released our economic strategy report, and in there it actually says that the downside risks to economic growth far outweigh any upside. So there's definite risk. National Retail Federation came out last week, predicted it would be the worst holiday shopping season since 2002. So people are clearly scared.
Okay, but crisis is a big word. We all agree on that?
I think it's a big word, but I think the Fed realizes we're near crisis and they're trying to do something to prevent it. There's a serious crunch and there's a serious problem, and I think we're at the beginning stages of the crisis, and that's why this action's why we need large action now. And I think credit needs to be given to Bernanke and Paulson for at least being creative and trying to ward off the problem.
Okay, understood. So Steve brings up a good point. What do investors need to know or do in order to protect themselves and be able to move forward with their investments from this point, from the point that this agreement or any agreement is reached in final form?
Okay, I'm going to take the first stab at this. I know a lot of people are trying to speculate out there, is now a good time for financials? I think you'd have to be insane to touch that group. I'm not saying that you couldn't make a profit somewhere down the road, but I'm saying anyone who's interested in trying to preserve capital at the time, their own capital, that sounds like a bad idea. Home builders is even a worse idea because their recovery will be even farther down the road than financials. I think that a portfolio of, a little bit of a flight to quality here, consumer staples, maybe even utilities, so companies with a steadier earnings stream, paying a dividend, and even some of the oil companies. And not that oil will resurrect so much, it's just because it's based upon a good they have that people want, which is oil, and they have healthy balance sheets, and they are paying out dividends. So that's a good one. Also, I'm going to say, unfortunately, watering down of the dollar with all this liquidity put in there, all these extra dollars floating around, that's got to bring down the value of the dollar, which is another good case for gold. Whether that's gold or gold miners, is a good time to put a portion of your money into that as a hedge against our falling currency.
Gold stocks.
Gold mining stocks.
rather than the hard metal.
Yeah, because you have more leverage there. So if you just do straight up gold, you have a little bit of a profit opportunity, but here again, also you minimize your losses. If you go with gold mining stocks, you probably have about 2 or 3 times leverage to the move of underlying gold in the direction that will go. So if gold goes up 10%, gold mining stocks probably go up 20, 30%.
All right, what do you guys have to add?
Well, I think one of the things that's important for investors to realize is keep focusing on what's worked over the long term. Fundamentally sound companies trading at an attractive valuation with rising earnings estimates. Those things do not change. The Zacks rank has worked for 20 years. It's been a tough third quarter for really everybody, but when you look at the long term, if a strategy's always worked, it's going to continue working, even though if over the short term you start looking at your stocks and go, this is not working. Don't change from your fundamental rules that have made you money up to this point.
Very true.
I think within the financial sector, however, I think you've got to be pick and choose. If you're someone who's going to ignore all the advice and say, I'm going to buy into it, I think you've got to look. If you look at J.P. Morgan, very successfully integrated Bear Stearns. There's no reason with their integration last week of Washington Mutual that shouldn't be smooth. They're really gaining market share. On the flip side, this morning on Monday, we hear about Citigroup buying out Wachovia, and it's very important to realize before this crunch happened, a lot of criticism about Citigroup being too large and about being unable to actually manage this division. So when you look at this acquisition, you got to kind of look at the history of this company and say, are they really going to integrate this merger? So I think if you're someone who says, you know what, I'm going to ignore all the negative downward revisions, I'm going to buy the financials, my advice is to really take a good hard look at what you're buying and try to go for the soundest names in the sector, not the ones that might sound good.
Or just stay away from it.
Absolutely.
We're going to give Kevin the final word. What should investors do?
You know, I'm going to mirror what Steve said, and it's something that I had said last week. I think you want to look at the top industries, you want to look at the top sectors, and I really believe you should look at your own spending habits. I mean, consumer staples, you're always going to be going back to that. Utilities, you're going to continue to be paying your utilities, phone and electricity, and all of this stuff.
Right.
Healthcare, you're not going to do without health insurance. In the financial sector, I think looking at REITs that specialize in apartments and rentals as opposed to new developments and condominiums and this kind of thing, I think there's a lot of good places that you can be, but I think it's important that you pay attention to the valuations, try to find companies that are deeply undervalued, look at things like return on equity. That will show you how good management is at being able to rein in their spending and be able to get a grip on costs. As long as you play it smartly, you look at the top sectors and really take a look at the income statement and the balance sheet, I think you can find a lot of great bargains right now.
And of course, come to Zacks.com frequently for the latest thinking from these guys. I want to remind you that the opinions expressed are theirs, not necessarily those of Zacks Investment Research or its affiliates. And with the whole gang, Steve, Charles, and Kevin, I'm Terry Ruffalo.